How many times have you heard, buy in the dips? Also, have you ever followed someone's advice and bought in a dip only to realize that you end up catching a falling knife? In this video, I will share with you some of my buy strategies to minimize your chance of catching a falling knife and to boost your portfolios. This is a how-to video part 1 on how to buy in the dips, on trading ideas for beginners and any levels of traders and investors. These strategies have high success rate and better risk and reward ratios. I will go over some of the basics on how to read the chart and give you some example chart analysis on how to identify these opportunities. You probably want to watch all the way to the end of the video, so stick around. Sawasdee krap, that's hello in Thai, and welcome to Quantum Finance. My name is Anthony, and I'm a former engineer and data analytics turned entrepreneur and investor. My prior career, I was very successful in creating predictive models for Fortune 500 companies in Silicon Valley using historical data to predict future outcomes. I applied my knowledge to my own portfolio, and in the past 12 months, grew it more than 550%. In this channel, I focus on high growth and disruptive technology stocks for short-term momentum trades and long-term investments. If you're new, welcome. And if you're returning, welcome back and thank you for your support. Please help us grow this channel by hitting the sub button below. Make sure to hit the notification button so you get my latest video update. While you're at it, do hit and like and share the video. I will see you down there. Please note that this video is for entertainment purpose only. I'm not licensed. However, that does not mean that I won't present you with facts and trading ideas that will supercharge up your portfolio. No BS and straight to the point. So let's get right into it. Since I don't know everyone's level of experience and knowledge on how to read candlestick patterns, and for the fact that this is a how-to video intended for beginner traders and investors, I'd like to cover some basics on what candlestick formations are and how to read them. Let's start with a brief history of how candlestick chart originated. Candlestick charts were created in the 1700s by a Japanese gentleman named Homa-san, who discovered that there was a link between price and the supply and demand of rice, which was strongly influenced by the emotions of the traders. Note the word emotions. This is because buyers and sellers move the markets based on expectations and emotions, aka fear and greed. He created the candlestick to reflect the emotions of the traders by visually representing the size of price moves with different colors. Today, traders use candlesticks to make trading decisions based on past patterns to help predict or forecast the short-term directions of the stock price. Also note that the what or the price action is more important than the why, such as news, earnings report, etc. And that all known information is reflected in the price. The candlesticks contain 4 price points: open, close, high, and low. The candlestick has a wide part, which is called the real body. This represents the price range between the open and close of the day's trading. Bearish candlestick is when the real body is filled in red or black, which just means that the close was lower than the open. Bullish candlestick is when the real body is empty or green. It means the close was higher than the open. Please note that there are many shapes and sizes of candlesticks. Here are some of the major ones. Each would have its meaning behind it. I won't be able to cover all the various candlestick patterns in this video, so in this video, I will only cover the hammer candlestick, which is number 4 below. Hammer candlestick can be recognized by 2 features: a real body at the upper end of the entire trading range, with little or no upper shadow or wicks, and a low shadow or wicks that is at least twice the length of the real body. The color of the real body is not that important. Umbrellas can be either bullish or bearish depending on where they appear in a trend. If they occur during a downtrend, they are called hammers and are bullish, as in the market is hammering out a base. If an umbrella appears in an uptrend, it is bearish. It is referred to as a hangman. The latter's ominous name is derived from its look of a hanging man with a dangling legs. One of the first criteria I'm looking for when to buy in the dips is looking at the daily charts. In particular, I look for a stock that is trending upward and in a parabolic rise. The definition of a parabolic rise refers to when a stock makes an upward price move that looks like the right side of a parabolic curve. A parabolic moves occur when the speed at which the stock's price goes up increases exponentially in a relatively short period of time. At some point, what goes up must come down. When the sell-off occurs, like the past 3 to 5 days in the stock market, I wait patiently and plan ahead looking for the optimal entry point. I will draw in the chart the support and resistance lines. I then look for a gap down on a rising stock. The reasons I look for gap down is that in most cases, it is an emotional panic sell or fear. This presents an opportunity to profit or greed. Of course, I will also check the news to make sure nothing major has changed in the stock. For instance, the recent sell-off is due to market correction and money rotating in and out into other forms of investment and just pure profit taking. When I see the hammer candlestick, I get excited because it's hammer time. The best time to check for the hammer candlestick is toward the last hour of trading day, like between 12 noon to 1 p.m. Pacific Standard Time, since I'm based in California. I look at the day chart and it will show to me that there's a hammer candlestick forming before the end of the trading day. That way I can determine if I want to get in early or not. Make sure to pay attention to the support and resistance line on your daily chart. This will provide a stronger support level than, say, the minute chart. There's more data or weight in the daily chart. Note that this strategy will only work if you have the patience and look for the setup to come to you. The other option is to use a stock screener software to search for one. I see so many hammer patterns out there, but I only will trade on stocks that I'm familiar with, as I would know how its trading pattern has been in the past. I would focus on stocks that have high trading volume for liquidity purpose, etc. Lastly, I look for a potential high short float interest. Why? That's because there will be a short squeeze. Remember how GME and AMC became a meme stock? Anyway, you can set it up on your daily momentum scanner to determine which stocks are being short squeezed. Anything above 20% is considered pretty good and relatively high, but anything above 50% or more is an awesome setup. You can check websites such as shortsqueeze.com or finviz.com to screen out stocks. Okay, now that we know more about key criteria for my momentum trade or investment setup on how to buy in the dips, let's look at some of the charts today. By no means are any of these charts mentioned in this video is a recommendation to buy or sell. I'm using it as an example to show you how to properly buy in the dips and to avoid the falling knife effect. First up is Sundial Grow Inc. or SNDL. It went on a parabolic as of late. It then dipped and trended downward. On Tuesday, it gapped down and formed a hammer candlestick pattern. This signaled to me that it has the potential to reverse its course today. Reverse it did. This created a new uptrend. Note that if you are a risk taker, you could have taken the position on Tuesday, 1 hour before market closing, and get in on SNDL. However, if you're not a risk taker, you can wait for today's confirmation. Statistically, it has about 80 to 85% probability that it will be confirmed for a reversal of a new uptrend. However, there is a risk to that 15 to 20% that it will not be confirmed of a new reversal uptrend. And therefore, a safer bet is to wait for today's confirmation that the reversal of a new uptrend has been confirmed and then enter the position toward the end of the days today or sometime tomorrow morning. Hope that makes sense to you. Next up is Immunon Inc. or IMNM. Note the parabolic rise. It dipped as anticipated. It gapped down and formed a hammer candlestick on Tuesday. Today, it confirmed a reversal of a new uptrend. The third stock is Cypress Solutions Inc. or SYPR. Note that the stock was not trending up but traded sideways. It did gap down and form a hammer candlestick on Tuesday. This was an indicator that it has the potential to reverse its course today. Boy, this exceeded my expectation as it actually gapped up and left Mother Earth. It went parabolic. Now the next stock is the one that I'm telling you to avoid, as you could be buying into the dip and be catching a falling knife. Sorry to those who own Workhorse or WKHS, but the price of this stock is moving lower. Note that it was trending up based on a rumor that it would win a contract. At its peak, it formed a hangman candlestick pattern on an uptrend. This signaled a bearish downtrend is about to happen. It did not confirm right away, but 2 days later, Workhorse started to trend downward. On Tuesday, news came out that it didn't get the contract and its stock tanked. It did gap down, but the candlestick was not a hammer candlestick, but a very big bearish candlestick pattern. Today's candlestick confirmed Workhorse is moving lower when it formed a bearish harami candlestick formation or a bearish inside day formation. Had you bought in the dip as everyone has suggested, you will be buying into a falling knife. And catching that falling knife is very bloody as it will cut you very deep into your portfolio. I hope this video helped you to understand how important it is to understand the technical analysis to help you become a better trader and investor. I will end this video by stating that the best investment you could ever make is to invest in yourself. And that is knowing how to read and interpret the candlesticks, read the stock charts, know how to read the trends, etc. The time and money you spent to educate yourself will pay you 100-fold or 1,000-fold compared to what you put in. Just remember that garbage in, garbage out. Once you know how to do technical analysis, you will know how to catch the fish yourself, if you know what I mean. In my next video, I will discuss how to use the doji candlestick pattern to buy in the dips. It will be a continuation of this video and will be titled How to Buy in the Dips to Avoid the Falling Knife. Do this to boost your portfolio part 2. So there you have it. If you find the content of value, please leave a comment below. Do share, like, and subscribe if you have not already done so. Also hit the notification bell for my next video. Now let's go make some moolahs.